Have you ever wondered how a company determines the cost of its funding? Let us break down the weighted average cost of capital. WACC represents the average rate a business expects to pay to all its security holders to finance its assets. Think of it as the blended price tag a company pays for the money it uses to grow the business. These three pieces determine the final percentage. Debt is usually cheaper but riskier, while equity is more expensive for the company. Don't confuse WACC with a simple loan interest rate. WACC accounts for the total cost of ownership, including what shareholders demand. As you can see, the mix of debt and equity significantly changes the calculated cost of capital for a company. This is why managers use WACC as a benchmark. If a new project earns less than the WACC, it destroys value. Understanding WACC helps you see how companies make investment decisions. Thanks for watching, and remember this is for educational purposes only.